hopefully into 2024 kind of begins to stabilize.
You're going to be left in the dust.
COVID hit right before they were trying to go public.
Like atrocious terms.
All right. Well, welcome to episode 2 of what we determined to be the CRE News Hour. We're excited to share some interesting articles with you today. Henry, always a pleasure to see you, my friend.
Likewise. Let's have some fun today.
Absolutely. So I'm going to go ahead and try to go set us up. So first up, we're going to go ahead and go to Henry's article. So if you don't mind kind of giving us a little bit of feedback on this particular article, that'd be awesome.
We're talking about industrial and retail dominating in the last few quarters, and obviously how activity has slowed down. We've obviously all felt it in some capacity or shape or form. Just talking about, I think this is an interesting point to bring up because like we had alluded to in the past, I think it's important to talk about diversity of asset class and being able to maneuver and shift and adapt. Certain asset classes are not doing as hot, like we've talked about previously. I think this is a really great outline. There's just opportunity in the water. There's so much freaking opportunity in my mind. I'd love to get your thoughts. I mean, like you see in 2023, they said that it was a correlation to 2014. So we haven't seen market like this since 2014. And I'm curious how you're adjusting or how you can recommend people to adjust.
Yeah, I agree with you. I think, what's unique is that we really haven't had an opportunity to really go through like a quote unquote normal recessionary period. I mean, we kind of had one. We were going into one really pre-COVID, and all of a sudden COVID hit and we went through a period of just absurd amount of spending, which created essentially quite a big of a bubble. So based on our current environment in 2023, I think we're just having this massive shift and correction, hopefully into 2024 kind of begins to stabilize. But as we've kind of talked about even in the previous episode, that the sentiment from the selling side, it's going to shift. I mean, there's a lot of sellers out there currently that kind of have an unrealistic idea of what their property is actually worth. And so as we start getting deeper into this period of time where we're just not quite having a lot of transaction volume, those sellers that have to be able to sell are ultimately going to have to do that in the future months. So I think that's kind of, where I'm thinking, and I know we've kind of harped on that a little bit before, but I appreciate the breakdown from the different property types as well, because, obviously we, as you can see, the real beneficial ones, obviously multifamily has been transacting at a high level, industrial historically is transacted at a high level as well. Hotels too, even post-COVID, they performed extremely well. I know a couple of big developers that own a variety of different hotel product, and they've been doing extremely well post-COVID as well. So I'm interested to see how it's going to play out over the next couple of years.
Yeah, I think that this is also a reminder that there is always going to be transactions occurring. I mean, even if you look in 09, there were still transactions happening. Not a lot, but there were still transactions happening. So it's realizing that like right now, at least from what we've seen, is that I think that like the big difference, at least this is just my 2 cents, curious to hear yours, is that like the additional the transactional volume, because we're about half of what we were in 2022. Right. Like, I think that was from a lot of those people who were just like, give me a crazy number, and you were just able to achieve it because of interest rates being at the points that they were. What I'm seeing is that like 2015 to 2019 is more of a normality. Right. Like this is what normal looks like. We were at crazy highs, which is not normal, which obviously would not last. And like you had said, I think we're going to come back down to, a brand new reality. It's got to shift hard first, and then it'll kind of plateau out, focusing on, again, the top 3, the main 3, industrial, retail, multifamily, still cranking. There's a lot of deals being done, and finding a way to structure and find those great opportunities for investors right now.
Absolutely. I couldn't agree more. So what I'll go ahead and do is we'll jump into the next article, one that I found extremely interesting, and we'll go ahead and share. And pardon with us, guys, we're working through StreamYard right now, and it's the first time around. So as we continue to utilize this platform, we're going to continue to improve. So
take these types of this information that we're going to be sharing with you guys, and like figure out what's one slight adjustment you can make in your business, right? Like you're not going to, like this is, we're trying to go through, really up-to-date news articles, which actually I saw the exact same one, I'm so happy you chose this one. So this one is fun. This is gonna be fun to talk about, but it's like, how can you take one little piece of information from today and make some slight adjustments in your business so you can see some success? So talk about this one.
For those of you guys who know, obviously WeWork has been under quite a bit of pressure on the financial side, and it's looking like it's more and more likely that things would eventually lead to a bankruptcy. As far as what led up to this point, if you guys have followed the story of WeWork, they were essentially subletting a bunch of space all across the cities around the world, and obviously New York, San Francisco, major markets around the country were beneficiaries of that. They were paying whatever landlords wanted essentially for a lot of their office space, and really didn't turn a profit at all. They were being propped up by significant investments by large firms, including SoftBank, which was their primary investor, billions and billions and billions of dollars. And the hope was that over time they'd be able to eventually turn a profit. Obviously, COVID put a damper on that, and most of the office spaces that WeWork has been occupying in the past, number one, weren't profitable, and thus they're trying to restructure a lot of these leases, and for many of them, they're just trying to get out of them altogether. And so, it's kind of compounding the issue of what we're seeing in the commercial real estate space, particularly in central business district office markets. And so, I think that what's going to happen over the coming months, which again, this has kind of been a slow train wreck over the last several years, will eventually come to a head. And I think it's just going to compound the issues we're going to face in the office market in the next few years. So
yeah, I agree. I think that, by the way, have you seen the documentary about this?
Yes. Well, I haven't seen the documentary. I've seen some YouTube videos on it to kind of, and they provided, I'm assuming, similar context, but
sure.
What did the documentary say?
I wouldn't say it's exactly worth the watch. I mean, maybe you watch it, just watch the last 30 minutes, because it kind of, the first 45 minutes is kind of just really slow pace, but you kind of get a taste for exactly what happened and leading up to the end, essentially, of the previous CEO, Adam Newman. I think what's interesting though is, like, I still think WeWork is a fantastic, very interesting model, right? I want to say it's a great business, because obviously they haven't really turned profit. I think in some markets it's really, really lucrative. In other markets, it's just really silly to do it. And obviously, we've seen regular office space in general be devastated, but I still think this WeWork concept there's still a lot of truth to it, right? Like, like I have an office at Regis, it's just a partnership we have with Regis, but I still think there's a lot of opportunity with it. I think that, it's funny. I've been watching this for quite some time now, kind of come to this point where, like, I figure they're going to go bankrupt, and I'm like debating, because if you look at their stock ticker, I don't even know what it's actually trading at. What's actually $2.38.
Yeah, which is crazy. I mean, the biggest thing that I think that is kind of a lesson learned, if you can draw from WeWork, was that it was trading as if it were a tech company, essentially. I mean, the multiples that they were achieving based on their earnings was absurd. And, I think that was just kind of in the midst of exuberance when it comes to all these different unicorn tech startups. And, Silicon Valley has just been kind of that watering hole for those types of ideas. And so obviously WeWork was one of those darling ideas that continue to grow over pre-COVID. And the crazy thing is, obviously, COVID hit right before they were trying to go public, and then that caused a bunch of issues. And then there was an internal tumult where the CEO had to step down, and they pretty much forced him out. And I think they have to contend with the fact that you can no longer just keep pumping money into an enterprise if it's not going to be profitable. And so they
went from, like, what, $400. I'm looking at it right now, $400, peaked out at like $5 and change, and then came down to now trading at $2.32. I mean, like, it's just actually kind of crazy to think about what that's that story. But for takeaway purposes, what do you feel like is something that you take away from this kind of story?
It's hard because I think the exuberance of what they were doing leading up to it, just signing leases for whatever landlords wanted, because they had to be able to justify to their investors that they were continuing to grow at a rapid pace. I mean, that is not good business. That's not a smart business. You have to understand why you're going to be doing that. If you're not going to be turning a profit, and obviously this is a counter to the point of Amazon, because Amazon was going through a period of time where they were rapidly expanding, but part of their business logic is that they're trying to service as many people as possible and quickly deliver product, which ultimately helped capture market share. So their revenues were continuing to skyrocket, but they were just kind of kicking the can down the road as far as taking profit was concerned. And that's a much more sustainable idea than maybe in this case, where even in the peak times, their occupancy was not 90%. They were like in the 60s to 70% occupancy, even in the best of times when it came to WeWork. So
yeah, I guess this is like, something I've talked about in my coaching program, which is, just leading with profit, right? Like not scaling for scaling purposes or scaling for ego purposes, but scaling through profit. I mean, like, there's no reason to, like, if I feel like this could have been such a fantastic business long term. I mean, who knows what's going to happen through this bankruptcy? I don't know how much is actually going to drastically change, just because, like, you see these companies that go bankrupt and then, they restructure a few leases and, like, they act like nothing changed. But, this is a really good point for, like, this business, and for business sake, is scaling through profit only, and it's the only way to sustainably scale.
Absolutely. No, that's great. Great advice. So next up is one of Henry's articles. So the housing market is getting colder by the day.
Yeah, I thought this was interesting to bring up just because I'm seeing this a lot, and I'm sure with your
Mhm.
audience too, where like a lot of residential agents are now coming to this world of the commercial world because
Yeah.
they're like seeking savior,
Mhm.
help me, because the market is so tight on the residential side, and they're seeing a lot of much tougher market. So I wanted to bring this up. I mean, this is a really interesting chart where like affordability is at a literally an all-time low since the 80s, which is where interest rates were at, 13, 14, 15, 18%. This is another reason why, they've had to skyrocket rates the way they have, the reason why Powell's been doing things that he's been doing. And honestly, did you see Patrick Bet-David's recent video about the interest rates and stuff like that?
I don't think I did. Yeah. What did he touch on?
He was talking about how he hopes that Powell does not get influenced to drop rates too soon. Obviously, like if we don't really drag this out for some period of time, which we're talking probably towards election time of next year, like if we do it too quickly, he was talking about how we might end up being another Venezuela, where like the stock market's incredibly high, but no one can afford it, right?
Yeah,
And
yeah, stagflation. You never want to get
exactly.
into a period of stagflation because right now we're still contending with inflation where it's at. And for those of you guys who are listening, stagflation is where you have high interest rates. Essentially, the Fed's pulled all the levers they can, but inflation still is going through the roof. And then at that point, you don't want to ever get to that point because then there's nothing you physically can do. You're kind of just along for the ride, and it does cripple economies. And you kind of see that in Venezuela. You've seen that, even post World War I, Germany went through a period of time where you could literally bring a wheelbarrow of money to a baker and it wouldn't even buy you a piece of bread. Like the value of the currency had been debased that much. So I'm sure we're not nearly that close to that. But again, it's one of those things where, you always want to tread the fine line, as they say. So.
Yeah, I mean, like, but what's interesting is that, prices really haven't come down much, right?
Mhm.
It's just like they really have gotten to a place where it is still kind of scary out there, right? I'm talking specifically the residential world, right? And even some in the commercial where like prices, again, have not changed so much. Like we're still hovering, at some, relative close to market, quote unquote, like of, a year or two, even though affordability has drastically fallen off. So I think that like, again, there is a wave coming. There's a massive wave coming of opportunity. And I think it's just those who are prepared will be in this cycle will come out so powerful on the other end. And I think that there will be, hundreds of thousands of realtors who don't capitalize because there's just not enough transactional volume happening.
Yeah, absolutely. And I think to your credit, especially with what you do on your channel, I mean, you're educating a lot of people, and not only just, commercial people, but also residential agents, and understanding that you can add commercial to your repertoire. You can get more educated on it. You can start transacting in the market because there are opportunities in both areas, obviously residential and commercial, but there's different verticals within commercial that you can explore that aren't just necessarily buy and sell, right? It could be leasing. It could be, structuring deals like you're doing with, owner financing. And obviously, you're buying and selling at that point. But again, you can get much more creative on the commercial side, whereas in the residential side, you can do creative financing deals and everything else like that, but it's not nearly as expansive as you can in the commercial end. So for those of you guys who are listening on the residential side, consider it. I mean, it really could be an option. Obviously, it takes time to get proficient at it, but this is the time to do that, especially in this period of time.
If you cannot figure out right now that if you cannot be the source of opportunities where investors can make money, profitable, great deals, you will struggle in this industry, right? This is an industry, especially economic times like this, where interest rates are at such highs in retrospect. If you're not focused on constantly trying to find these types of opportunities, you're going to be left in the dust. The deals will not be done they haven't been done recently, and they will continue to not be done in traditional facets. So it's educating yourself, like having conversations with your accountants and understanding tax law so you can understand how seller financing can be beneficial and what aspects aren't. Speaking with, watching content online and understanding how to structure creative deals are going to allow you to capitalize in certain circumstances where other real estate agents are going to just, they don't want to list it. Goodbye.
Yeah, absolutely. Couldn't agree more. All right. So next up is an article I found on Globe Street. If you guys don't follow Globe Street, I highly encourage you to. They have some of the best commercial real estate content out there. But U.S. commercial real estate debt grew by 5.9% in Q2. So as you can see here, the universe, as it references here, the universe of commercial real estate mortgage increased by $320 billion year over year, or 5.9% in Q2 of 2022 to 5.8 trillion in Q2 of 2023, according to the Federal Reserve's flow of funds. What this indicates is that deals are still getting done. Now they're being more stringent about the deals that they're actually going with. And again, this is based on conversations I've had with lenders, both on the regional side. We've talked to some national lenders as well. Again, they're being a lot more selective about the deals they're doing, but don't use it as an excuse saying, hey, they're just not lending right now. People aren't doing deals. They're doing deals. It is happening. But again, they're just being more scrutinous about it. You may not get a spec build for a 1.5 million square foot building done maybe in this environment unless you're super well capitalized, but some of these other opportunities could present themselves. So kind of look at this as a way to say that even though transaction volume is down 50%, there's still opportunity out there.
Yeah. And like, this is also to your credit of like having the relationships with commercial lenders right now and understanding their game as well as they do. So you can speak intelligently to the clients you're working with, which is again, just talking about like structuring great deals, because the deals that are being done right now, debt wise, are ridiculous, like atrocious terms, ridiculous terms, things we haven't seen in quite some time. We're talking 40% down and 45% down, talking 8+% interest with 2-3% points up front, with also in some instances for small mom and pop banks, you're looking at putting in $500,000 to $1 million worth of money in the bank to even get the loans done. I mean, it's like you're almost financing your own loans. This is why it's like important to talk about structuring great deals, where we've been structuring deals with seller financing where sellers are holding back a decent portion of the down payment, right? Because it's very hard to be profitable when you're putting 50+% down or 50-ish% down in totality, plus then construction costs. It's like this is fantastic to point out. And like, listen, if you don't have a great commercial lender, find somebody in your local market and really understand the game right now, instead of just saying, oh yeah, like, I'm just trying to pitch a sell and not understanding how the loan side works.
Absolutely. Yeah. I mean, and understanding that you take the pulse on the capital markets and get an understanding of how the capital markets are operating and how they look at opportunities and how that idea shifts over time. Because I can tell you right now, these banks that I'm working with, and I'm not going to name names, but let's say I have 5 or 6 lists of lenders that I deal with on a regular basis. I talk to these bankers all the time, and they're telling me, well, this is kind of how we're operating right now. This is the type of, debt service we're looking at, or, whatever, metrics they're looking at. They'll relay that information to me so I can better advise clients or better advise investors to say, hey, maybe go with these lenders that this is the type of stuff they're looking for. So again, it's just becoming more creative, understanding what the landscape looks like, and then just executing. So again, I think that, I guess the moral of this story is saying, get educated during this period of time. And if you still got to get out there, you still got to hustle, you still got to make sure that you're getting deals in your pipeline. But this is a time that you need to educate yourself and become the expert that you need to be in order to ultimately come out of this thing and become a rock star. So
getting a better education and becoming the expert around the world of financing, the world of deal structuring, the world of finding and sourcing these deals. If you can focus on these 3 points, you'll be unstoppable in any economic times.
So next up, we're going to share it. All right. Next up is one of Henry's articles. So U.S. industrial tenant demand slows further in third quarter.
Yeah, I thought this was interesting in the sense where just because there's industrial transactions happening doesn't mean all over the country that you should be investing in it and trying to sell your investors on buying it, because in some markets, it's still probably the best asset class you can get your fingers on. However, in other markets, I think it's something that I would be hesitant to looking at unless the deal's absolutely out of this world. So this is just showing tenant demand, like you had mentioned, where leasing activity it was crazy. I mean, if you look like we talked about, like the normalcy in regards to 2014, 15, 16, 17, 18, 19, and then 2020, 2021, where it starts kicking off to these ridiculous numbers where there was so much demand for square footage every quarter that they had to build. I mean, like, it's like the housing demand right now. And now we're seeing such a crazy pullback, a huge pullback, where we're actually dipping below. We're almost at the lowest points, since maybe some parts of 2018, 2014, 15 or something like that. So it's just, keep this in mind that, like, if you're focused on industrial leasing, maybe it's focusing on better markets where there's more transactional volume going on, where there is more demand, instead of just saying like, oh, well, I do leasing in this city because that's where I live. It's saying, no, I do leasing everywhere because this is, or in this specific area, because that's where demand is.
And understanding the landscape of each of the markets. I was just at a regional conference for our region. So I'm located here in Louisville, Kentucky. We had people drive down from Indianapolis, Cincinnati, Nashville area and such, and they were giving like an industrial market update for the region. And a gentleman that works at a firm that they own product all over the country, but they have a contingent of property in the Midwest. He was even mentioning that in the Indianapolis market, particularly the southern Indianapolis market, they had a lot of available property in that 500,000 to 1 million square foot range. And so if you're kind of playing in that sandbox, you're kind of at the mercy of the tenants. Whereas if you start getting into smaller product like 100,000 or 25,000 square foot building, you have the flexibility to now offer it to a multi-bay industrial, and that is still very active. And I'm sure a lot of parts of the country that's the case. But again, if you play in that 500,000 square foot sandbox, the tenants have it's kind of shifted in their eyes and their stance. I mean, the tenants have more power now than they did in 2020 and 2021. Maybe that's unique to Indianapolis. I doubt it is. I think there is obviously a shift happening there, but
well, I think that it's more so also of these large corporations. You take Amazon as an example. It's not like they have endless expansion options here. They needed to expand the way they did because of the demand through COVID. Now that is not the same anymore, and they also have now acquired all these locations, which I mean, like there was even articles out months ago where Amazon was subleasing some of their space because they don't have a lot of their space. Exactly. Mm-hmm. By the way, they actually also just signed one of the largest leases in the country in San Francisco, 1 million plus square foot lease out there. And it's just important to pay attention to, like, it's not like the demand will not be endless from these huge corporations, because Amazon was one of those leading companies where now that they have all these space and now they're kind of over expanded in these areas, they don't need the space anymore. So it's like you had mentioned, I think that where the value is now targeting these smaller flex spaces, maybe a few 100,000 square feet of flex space. We have a little bit of office in the front, and then a large percentage of it being warehouse, where you can rent it out to multiple tenants instead of these big, huge corporations.
Absolutely. Yeah, I would agree with you on that. That's what I'm seeing locally here. And I'm sure it's not specific to my market, but I'd love to hear if you guys are watching this, comment in below as well to tell us how it's operating in your market as well. And I will go ahead and pull up the next article. All right. So next up is commercial real estate forecast / for 2024. So this is based on the Mortgage Bankers Association. They slashed their forecast for commercial real estate production next year and lowered expectations for this year by 12% as it finds delinquencies are continuing to rise. The forecast released October 19th contained the MBA's first major change in its 2024 forecast for a total and multifamily loan originations. Production for this year was revised downward by 23% on August 3rd for all loans and 20% for multifamily. So again, it kind of lends the same logic. It lends itself to that banks are becoming a lot more picky about the loans that they're doing. This doesn't mean that they're not lending. There's still volumes, metrics they're trying to hit. Maybe those have been modified slightly, but again, there's still deals being done, but we're not going to sugarcoat it and say that banks are just absolving or not even looking at things like they were previously. So
yeah, and I think, again, this is great to pay attention to, where think about it like this. If hypothetically you knew, because you had insider information, because in real estate, it's not illegal. We have all this information and we can make judgment calls, and it's totally legal, right? That we're supposed to be doing it. And it's like, if you knew that banks will treat X asset class differently and harsher than other asset classes, why would you continue to try to do deals where it's more complicated? Why would you push in a direction where you're pushing a boulder uphill versus downhill? There are asset classes like office and mixed use deals right now that have much worse terms than traditional multifamily or traditional industrial or retail. And it's like paying attention to these things. Like multifamily's always had the best terms of any asset class.
You're right. I mean, you can get 30-year loans. I mean, it's certain, depending on the loan product, you can get longer amortization loans with multifamily, whereas with other product types, not quite the same terms. So
I've had some of my salespeople recently where they bring me a mixed use deal and they're like, oh, well, the price per square foot's fantastic. Or, the cap rate on this deal is fantastic. I'm like, it better be, because they're not going to get a great loan on this, right? It's just infinitely more complicated to get a loan on these types of deals. So keep this in mind. Again, like we've been talking about, it's like, if you're going to be prospecting something, which all of us have spent time lead generating, or at least I hope so, every day, you should be prospecting things that have the easiest ability to sell on the back end.
We'll do one last article that Henry has. All right. So this, so Vicky strikes a $433 million deal with bowling center operator Bolero. Nice.
Okay, so the reason why I wanted to bring this up, similar to what we actually just brought up, there are large corporations, there are companies right now, successful companies. Bolero's on the stock exchange. Okay, like this is a major corporation who is doing a major leaseback. This is insane. Because like the reason why I think this is so cool is because, and this happens at every level, guys, where there's deal opportunity, where you have a huge corporation that just sold off 38 properties here for $433 million. And if you scroll down, you'll see that they're getting this deal, which they're, Vici is a huge investment company. I just wanted to go down to the cap rate real fast. This is a huge deal that's being done where it's like these companies are selling. This company, Bolero, just sold for $433 million, and they're doing an annual leaseback of $31.5 million, representing a 7.3% return or cap rate on this deal, with a 25-year lease with 6 5-year option renewals with escalations every single year, 2% max out at the CPI. This is so awesome to me because we're seeing deal opportunities where, like, if you're wondering where deal opportunities are, there are companies that are doing well and would love a cash injection. Bolero would love a cash injection of $500 million, pay off as much, any debt that they might have, clean off their balance sheets, and just be able to rent and still be profitable. It's finding these types of opportunities. I just was like, I love this. I love seeing this. I wish I was Vici, finding deals like this. This is fantastic.
Well, and it's also understanding how to talk to owners, because a lot of times when you call an owner that owns a property, you say, hey, are you interested in selling? And they'll be like, no, I'm not really that interested in selling. But if you can kind of explain the value proposition of even executing a sale and leaseback, for example, especially in this environment where the capital markets are tight, maybe they want to go expand into a new market, but maybe their banking relationship has decided to kind of pull back a little bit because of what's going on. Like, one of the best ways you can access that capital is to just tap into your equity. And by doing that, by selling your property and taking the cash and then using that money to go do what you want to do, there's a lot of benefits to it. And so if you can have that value proposition, obviously that's super beneficial. And one of my buddies who's also a broker, Logan Hartle, he's done that quite a bit in the past as well. So very smart opportunity.
Huge opportunity. And we're seeing, like, right now, one thing that we're targeting is we're pulling lead lists where individuals have bought properties where they bought them at steals. They bought them at $50 to $75 or less per square foot in great areas. And they've owned them for, like, these properties haven't traded in the last 10 years. They've owned them for sometimes 15, 20, 30 years, where the owner occupied the building. And we're able to structure now that, they bought it at $50 a foot. And now we're offering them $122 a foot, and they're making a great return, quote unquote, on their building. However, we're buying it at a fantastic price. We're structuring an 8+% cap rate day one plus increases, where in a 5 or 6 year period of time, you could be at a 10 or 11 cap. It's like there's huge opportunities for investors to make money on these leaseback deals.
I'm glad we're able to do this again. This is episode 2 of the CRE News Hour. We've been doing this. We're continuing to do this every week. Looking forward to kind of engaging with you all in this medium going forward. Would love to hear your feedback as well. So if you guys are watching this on YouTube, LinkedIn, wherever you guys are watching this, please type away in the comment box. We're going to go ahead and review this and over time iterate to make this as best possible medium we can make it. So absolutely.
And we're going to start doing this a little bit more regularly on Wednesdays, I guess, right? We're going to choose one day of the week. We're going to go live at the same time, try to make it super consistent for you guys so you can find us at the same place every week at the same time. Number one. Number two, if you come across anything interesting, make sure you let us know in the comment section. If you come across a certain article or a certain topic or anything that you'd like us to jive on or to have a good fireside chat on, make sure that you let us know in the chat. We'll make sure we rip on that in the following episode. So besides that, we appreciate it. We appreciate the love. Make sure you give us a thumbs up, love the content, and make sure you subscribe if you haven't yet already.
Thank you all so much for tuning in, and we'll see you all next time.